Well, thanks so much for tuning into this earnings conversation with Sandeep Kalra of Persistent Systems. They came out with a quarter wherein the environment may have been chalky, but they've come out smelling like roses because the revenues were up another 9% QOQ, slightly higher than Bloomberg estimates. EBIT margins expanded by about 800 basis points, if I'm not wrong, and the PAT up 4% at 220 crores versus the Bloomberg estimates of 214. Sandeep, as we do the norm, thanks so much for joining in. But as we normally do, can you just give us a brief about how you thought the quarter shaped up?
Sure. First of all, thank you for having me, Neeraj. Good morning. So, as you rightly said, we delivered yet another good quarter. So, from our perspective, it is a quarter of solid growth across various business metrics. The quarter two revenue came in at 255.56 million. This gives us a quarterly growth of 5.8%, sequential, and 40.2% year on year in dollar terms. Adjusted for currency, in constant currency terms, this translates into sequential growth of 6.6% quarter on quarter. And in rupee terms, the growth was 9.1% quarter on quarter. So if you look at it, pretty strong quarter. Four things that I would want to highlight for this quarter. Number one, we reached the annualized run rate of $1 billion, doubling our revenue over the past 3 years. The same quarter 3 years back was $125.5 million. Compared to that 125.5, we are at 255.6. We achieved quarterly run rate in excess of 2,000 crores. This is the first time in our history we have done that. The TTM EPS crossed 100 rupees for the first time, and we were included in the NSE IT index, which is a fairly proud moment for all of us. So overall, pretty good quarter. So over to you for any questions.
Okay, yeah, bunch of them. So first, last quarter, Sandeep, you were talking about how order bookings done through the quarters held you in good stead of strong growth. Now, this time around, too, when I look at the TCV, the ACV signings for the quarter, they are almost at par with what you did in, let's say, quarter one as well. So while the world is talking about how services growth, IT services growth might be under question mark, your order signings don't quite show that.
Right. So look, everyone has to deal with the macro in their own ways. If I look at our own company, we are very well differentiated on a few things. In the ISV space or enterprise software space, whether it is horizontal ISVs, vertical ISVs, we have the best seat to the table and the right to win. And so some of the deals that we have been doing at scale, a lot of our peers believe enterprise software market is slowing. For us, it's accelerating. So for that, our ability to differentiate is very high. Same for the enterprise market. The investments we have done in things like Salesforce, data, AI, cloud, and the acquisitions that we have done position us very well. So far, thankfully, these have led to good deal wins. And look, the macro is where the macro is. So one can say, look how bad the macro is, or one can decide within the macro to see the opportunity in the adversity that has been given to us. So far, so good. Now, obviously, I wouldn't make any forward-looking guidance, but if you just look at the order wins, $1.45 billion TTM from a TCV perspective, $1.1 billion roughly from a TTM ACV perspective. So they should hold us in good stead from a revenue perspective. And then obviously we have to keep working to get more order wins.
Yeah, TTM ACV nearly 1.2 times revenue, and that's a pretty strong number. Now, just one quick follow-up. The IP-led revenues, they had a decline in quarter one, and I remember you saying that while quarterly adjustments may happen, you reckon that strong growth would continue for the year. Can you fill us in on that?
Sure. So look, the IP revenues for us, as we have always said, they comprise three things. One is the revenue that we do with one of our largest customers, where we engineer, they sell. Second is where we embed some of our partner IP into our solutions that we take to market. Third is the IP that we own. These are a slew of enterprise software products that we have taken over from the likes of Intel, HP, Citrix, etc. over a period of time. And we've always said that, look, we will deal with IP in two ways. One, sell the software products, the third category I talked about, as software products. Two, once we have those products, there are certain things that we can reuse in our services business as well as IPs. So we have been working on it consistently, and thankfully, some of that strategy is playing out very well. And look, a business is a portfolio of customers, portfolio of service lines, industry verticals. As long as the culmination of that can, help you grow healthily quarter on quarter, one quarter something may be up, something may be down, and so on. So IP has played out well for us, and it will not be like 40% year-on-year growth that we've seen in our services business or more, but it will have a healthy, decent contribution to us.
Okay, so there's this set of notes which speak about a spending pause in your top client and how it's come off in the last quarters due to restructuring events, etc. How would you kind of talk about that or throw light on that?
Sure. So there are customers, whether it is our top customers or it is any range of customers, we have worked with them for 10, 15, 20 years also. There are new customers, there are old customers. Now, when a customer decides to react to a macroeconomic environment in a certain way, trying to optimize their own spend for good, we have to be with them on that journey. We can't just have a one-way lane that we expect customers to just keep spending more on us. When they want to optimize, we have to be on their side, and in return we come out stronger in the longer run. So there will be, customer specific puts and takes, and we don't want to discuss any specific customer because of confidentiality, NDAs and other reasons, and we respect that. But look at it overall: 5.8% sequential Q on Q dollar terms, 6.6 plus in constant currency terms. I don't think there are too many companies at that level. As long as we can manage our portfolio, as long as even revenue to profitability we can manage, we can keep growing at industry leading growth. I think we should be happy, and there will be times when we help our customers and they help us over a period of time. Those are where the relationships become stronger.
Indeed. So Sandeep, net, and I'm not looking for a particular kind of guidance, but net, yeah, you would reckon that so for example, you telling me that since you're balancing portfolios out here and some clients are doing well, some not, if the street is unduly concerned about what's happening with segments like Salesforce, you are not, or are you?
So look, again, one can say, look how bad the market is, or one can say, what is the strategy in a bad market to find opportunities? So are we concerned about certain, specific companies? And I will not comment on Salesforce. They're a good partner of ours. I want to refrain from making any comments about a specific customer, specific partner. But your comment being fair, look, it's like this. Within the same market, we are finding newer opportunities to help our customers, which are meaningful to them. Where we are, for example, in the last quarter, we won a TCV deal of $80 million. One single customer, one single deal. Quarter before, $70 million. TCV, one customer, one deal. Why? Because what we have to offer is very relevant to that customer in their forward-looking journey. And these are 5-year deals. So as long as we can figure out the intersection of what we have to offer, what is the value that we can bring to a customer, and how it can help a customer, scale and optimize their profitability as well, will come out winning. And we can't solve the world hunger, but we'll solve the persistent hunger.
Makes sense. Actually, one of the ERD companies tells me that, for example, that regions are not troubled, but clients within regions are troubled. Some clients are troubled, some are not. And he was talking about how, in his case, they are trying to work with clients in order to optimize their own work relative to whatever they have been doing. I mean, you kind of making some points which are similar there. And if I'm sorry, I'm just extending this question to something that happened last quarter as well, right? Because if I'm not wrong, one of your largest deal wins in Europe came in last quarter as well. So there is a lot of pessimism around what's happening in Europe, maybe in US, etc. You don't reckon that it will naturally come out to all companies? Companies like yours will pick and choose and fight battles and win them.
Look, the pessimism is there in the market and people will optimize. Now, will we grow at 9% that we did for the last 5 quarters? And in rupee terms is the 6th 9% plus quarter. Look, if the industry grows at X percentage, we'll always try and be at X plus delta X. And the delta X may be significantly higher or whatever. There may be smaller puts and takes. So there may be, a slowdown that may be coming our way. I don't know. We will try our best to be the best in class. And that's what we have delivered. We have a track record. In your terms, this may be the 10th quarter of sequential revenue increase and profit stabilization and increase. And so from our perspective, we are working very closely as, the other person that you talked about. There is merit in whatever the person said. As long as you work with the customers, sometimes even cutting your own spend and optimizing it for their benefit or helping them cut their spend for the longer run, there are opportunities galore. Now we have to work at it, not being overconfident. That's where it is.
Okay. Let's talk a bit about the margins as well. I would have thought when you told me the last time that it's a quarter of wage hikes, that there will be pressure. But you would also mention that pressures coming into mainstream after training could help margins. So what's gone right for you to expand margins 80 basis points this quarter?
Sure. So let me give you a margin walk from there. So if we look at it, the salary increases, they contributed to negative 230 basis points. So that's a negative impact. Now, if you look at it, the higher IP revenue, this is our IP. So the more we sell that, and we have to be prudent, the more we sell that, it comes at lesser cost addition because the cost is already there. So we were helped by about 80 basis points on the IP led revenue. We were helped by the currency, which is not in our hands, but thankfully it helped us. 90 basis points on the currency side was the impact. Then there were some other things like travel expenses, visa filing, etc., which happened in the last quarter, which are not there this quarter, and so on. So if you look at it with those puts and takes, and the depreciation amortization being a little higher, we were able to come from 14.3 to 14.6%. Now, the next thing would be, can we sustain these margins? So from our perspective, look, pay hike is done. We have absorbed that pay hike impact, and hopefully, we are good on that. Attrition is stabilizing. We had a little lesser attrition in this quarter. Hopefully, it will incrementally, slowly go down. As far as the freshers are concerned, we have not deployed majority of the freshers yet. Actually, it is less than 10% of the freshers deployed yet. And we have a huge amount of that inventory. So from that perspective, we are training them over the next 1, 2, 3, 4 quarters. All of them will get, deployed. That's a great margin lever for us. The cost is already in our books. So from that perspective, there is a significant number of things like that, and not to forget utilization, where we could always do better. We could always go up by about 2 to 4 percentage points. For every percentage point, we get about 30 to 35 basis points in our bottom line improvement. So there are those things, and currency, hopefully, whatever currency exposures are, we have much lesser on Europe. So US dollar is the exposure we have, and that's good.
Okay. How much headroom on the capacity utilization side that you have? I mean, before you ideally try and not tweak it.
So right now we are in the range of 79%. We would be happy to take it up to 80 to 83%. Wow. Beyond that, I wouldn't want to take it. So there is still 3 to 4%. So that gives us, multiply that by 30 to 35 basis points. That's the pool that we have.
Okay.
Along with other levers.
Got it. Just one quick follow-up. Did I hear you say that attrition has come off a little bit? Because in Q1, you in fact pointed out that, if you adjust it, attrition has been high for you. You were candid enough to say that, even though I had not asked you.
Yeah.
How was Q2?
23.7%. And so it's come down slightly. And interestingly, so we obviously, this is the rear view mirror. But when we do business, we are always, looking forward and forecasting. So while we talk to you on this quarter, we are already working on the next. So we can also see the trends. So the trend is the same or slightly lesser.
Chalo, touch wood. I hope that works out even better. My final question, Sandeep, and something that I asked you the last time around, this time around, just because the talks are that much more pronounced. So therefore, I would want to understand your view there. Could the playbook for Indian IT services this time around be different than the previous two times that the West has had a recessionary / slowdown episodes?
So look, the playbook for Indian IT industry at a Uber level may be somewhat similar. But look, the Indian IT industry is not one monolith. There are bigger peers of ours, general purpose IT services companies, different plays, right from commoditized infrastructure services to differentiated plays in their own ways. And then there are the mid tiers and many good mid tiers. Some focus on industrial, some focus on financial services more. We are focused on the tech market more, and everyone will have to have their own place. As far as we are concerned, we have a very clear defined playbook for this market. I will not talk too much about it here, but there are 4 or 5 plays we are going after, and we are seeing success in that. So everyone will have to figure out their customer segments, their capabilities, their right to win playbook wise, but more or less, everyone has figured out with slight different twinge from one to the other slowdown and has come out winning. Overall, I do believe very strongly, if somebody is looking at this market and the IT services, companies as an investment for the longer run, it is a fairly good thing. It'll slow down a little bit, but it'll come up big time.
On that note, Sandeep Kalra, thank you so much to you and your team and family. A very happy Diwali and a prosperous New Year. May the good times continue.
Thank you, and the same for you and your viewers.
Thank you so much, Sandeep. And viewers, thanks for tuning in.